Hello and welcome to another Ferrari Financial US market news summary. Well, this week Wall Street showed a little bit of stability in the light of very poor economic news all week, culminating in the disastrous monthly jobs report showing the biggest decline in jobs in 5 years, and yet the market withstood such punishing news. I think, as we said last week, the market's decided to take a short breather and is consolidating really regarding all the news at the present time as already being priced in. And in many investors' minds, the bad jobs report on Friday was just confirming what they already knew, that the US economy has really started in recession at the moment. And in the first 3 months of this year alone, 232,000 jobs have been lost. So the market ended the week a little higher and looks set to stay much in that condition until the start of the earnings season really tells investors how companies fared in the first quarter and how much the recession seems to be biting and hitting corporate profits. So I think the consensus at the moment is a wait-and-see attitude, particularly with regard to the earnings reports coming out soon, and also to see if the credit crunch, the banking problems have abated for the time being at least. Let's take a look at our chart. We're going to take a look at the one-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas, we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark at 2,208 was the worst level before we had the pullback that we've had in the last week or so on the promise of a nice fiscal package with some tax cuts, and of course the Federal Reserve stepping in with an interim interest rate cut, followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback or consolidation over the next few weeks, before then the market would probably turn southwards again. So investors may be showing a little bit more of an optimistic outlook at the moment, judging by the market movement last week, but I don't think it's a view shared by most technical analysts. I think their view is really the pullback of the last week or so has been just a normal technical retracement of the very steep declines we saw in the last month or so, and to be expected. If you study the chart, and in particular the level that we're now approaching again with regard to the 200-day moving average, then technical analysts would really consider that between around the 2,450 to 2,500 level, the market should start encountering quite severe resistance to further upward movement, and probably think about turning south again. Certainly, if the start of the earnings season proves to be disappointing, and more importantly, if companies' forward guidance is even more discouraging, then I think it will give the market even more of an excuse to take the short-term profits, or if anything, in the way of limiting losses before moving down again. If we were to pull back a little bit and look at the chart action over the last 5 years, you can see that the head and shoulders reversal pattern that's just completed is showing really only the start of a downtrend. And when you consider that the bear market, which is now in place, has probably been only in place for about 3 months, and typically bear markets can last anywhere between 9 months and 2 years, we could be in for quite a bit more of a downtrend before this is anywhere near over. Well, we're likely to find out in the next 2 or 3 weeks. We'll be watching the corporate results as they come in very closely. Until next week, it's goodbye from London.